Okay, good. Thank you. Let's get started. And as people joining us, I will just review what we did last time. Last time we basically started the cost of capital. In fact, we spent the last two sessions, and today we'll finish this topic, which is one of the major elements of valuation. What we did last time, we talked about cost. First of all, we did example on previous year, if you recall, and we solved that. We dived into that really deeply. That shows us how important is the work and how important is return on invested capital. And then we started talking about cost of capital. We focused first on cost of debt, remind you. In the cost of debt, we said, depend on the type of company we have. If it is a traded company, then I would calculate yield to maturity, and we give examples. That's in that case. If we have a company that doesn't have traded bonds, or most of their debt, it's not traded, we might be lucky and we find some rating of that company, and based on the rating of the company, we can find the spread of that company. What does that mean? That if we have a risk-free, we add to that some component of risk based on the grading of the company. The more risky is the company, the higher will be the spread. That spread is being published by several companies. Gartner published that one on several industries even. And the companies that give grading to other companies is like Moody, S&P, and there's others. And that was the second method. The third one, it's if a company. Go ahead.
I'm sorry to interrupt, and I feel maybe it was answered before. I'm just not sure on how we find the risk-free rate. I mean, up till now we were always got it as a given. They told us in a question the risk-free and the rate in the economy is 1%, 2%, whatever. But
right. We discussed that about 2 sessions ago, and we said this is really looks like so obvious. You never really have to find it out yourself.
From the
you always were given. And what I mentioned in the previous session, that based on the discussion we had, that for risk-free we use the 10 years government bonds, U.S. government bonds. Why 10 years? Although theoretically we should use as long as possible, which it's 30 years, but since the yield of those bonds is so volatile, we compromise and we take 10 years government bonds.
Yeah,
and we also said,
yeah,
and then also we said that it's usually around 2%. That's really what we see in the last several years. And that seems to be the case for several years to go. A third method is if the company has CDS, okay, credit default swap, which is basically like kind of buying insurance on buying bonds of a company. So that one reflects really the extra risk you're taking by investing in this company and not in risk-free. So that could be a good estimate for that spread as well. And then finally we said, which is really the majority of the companies that are traded on the stock exchange, you really don't have, for most of them, either one of those 3 methods. So for that case, we use what is known synthetic rating. What does that mean? We calculate interest coverage ratio. Interest coverage ratio is the ratio, as we did here for Netflix for last time. We take the EBIT, we divide the EBIT by the interest expense, we get a number. This one is the interest coverage ratio. Based on that ratio, we look at the table. By the way, that's done automatically in the simulation because this table is embedded inside the simulation, and the range that in which that ratio falls, it's between 3 to 4.25. It is A3A, and the default spread for a company with this kind of a rating is 1.3. So if we look at the simulation, we're getting here the 1.3, meaning we need to add to the 2% a company risk, which is 1.3. Finally, we talked about, after we did that one, that was the case for US companies. Let me just change that one for United States, which we don't have any country risk. The spread for country risk is zero. That will be the case. But what happens if the company is operating in a risky country? Let's say not really that risky, but higher than the US risk. Let's say, how about United Kingdom? It's already that risky, but has some level of riskiness than investing in the US. Then we add what is known a country risk. So we're adding the 2% risk-free, we're adding the company risk component, 1.3 in this case, based on interest coverage ratio. And then we concluded by adding the country default spread. Where these numbers come from, it's also embedded in the simulation, and I gave it to you. Okay, it's based really on summaries of historical data for different kinds of countries. Then we moved on to estimating cost of equity. And in the cost of equity, we said we're using the CAPE model. That was the cost of debt. Then we moved to cost of equity. And we said, for the purpose of this course, we're going to use the cost of equity based on the CAPE model. Again, we use the risk-free. That's as we estimated before, about 2%. And we are missing two very important parameters, is the beta of the company and what is the risk premium on the market portfolio. And we said last time that those two numbers suffer substantially from big variance in the estimations. When we look at the expected return risk premium, we said, okay, let's look at the last several years. And then the first issue was, how many years in the past should we look? That was the first dilemma. Because we see that if I go almost 90 years, I get 6.38. I go 50 years, it's lower. I go only the last 10 years, it's higher. So which one should I use? Then that was another first question. The second question is that we talked about last time. Both of them has a high variance, very standard deviation. The last 10 years is extremely high. So using this number would not be that reliable. Then we said, okay, let's compromise. Take a number between those two numbers. We know it's not perfect, but this is the best we can get. So we said we'll use something like 5.25. And I said that that's what you should use also for your paper. It's a good estimate that nobody will really challenge it, okay? Then we said not to forget, okay, the last point, survivorship bias, meaning even those estimates, after all, what do we do here? We take, let's say the S&P as reflecting the market portfolio, subtracting for it the return on bonds, 10 years government bonds, and every year we take whatever is the index of the S&P. But the indexes always include companies that exist. Meaning if 10 years ago in the index, the S&P 100 had 100 companies, they are not the same companies in 2020. And there might be some companies that even went bankrupt. And our estimate will always take only the successful companies, meaning we're overestimating the return on the market. And that's what we call survivorship bias. People still use it. In fact, those numbers that we have here suffering from that, it's not that substantial because after all, it's very rare that a company in the S&P 100 will go bankrupt. So it happened once in 50 years maybe or so. But you never really know, like Lehman Brothers, nobody believed it's go bankrupt, but it's still, the Lehman Brothers should have been in the index. And if we do the index, they are not really. So just be aware to the last point, okay? So there are three things that this measure suffering from, but still that's the best we can get, and we use 5.25. Then we went into the last component. How do we estimate the beta for the company? And as you studied in finance class, You're just supposed to run a regression. And when you do that, unfortunately, you'll get an estimate and you'll get it with a huge standard deviation, meaning the numbers is not very reliable. And then last time we started the discussion, we said, what should we use? Some of you, I think someone in this class have mentioned, how about using comparable companies? And I said, that's a great idea. Okay, and we're going to cover that today. The second way is just saying, okay, let's see what is the beta for the industry in which our company operates. And if our company operates in several industries, we might even take a weighted average of that beta. So in fact, I started from a second method, and this is also the method that you use in your paper, which I prepared for you. For example, for Netflix, this is the company I'm showing you here. They're mostly in the entertainment, so I chose the entertainment. I don't think there's other industries that are majorly invested that I can split it to two components. I showed, I think, last time with 3M. 3M has like 4 industries. So if you have more than one industry for the company, click this button and choose the second industry. And then in this simulation, you can put how much revenue your company is getting from each industry. It will calculate the weighted average of those 2 beta. By the way, in this case, I just chose beverages. This guy won't make much difference. It's very important.
Just a little question. If there is, let's say they are involved in entertainment and let's say maybe 1% of their whole, you know,
1%
business is in beverage, or let's say 10%, you know, so the weighted average
10% is substantial, yes. Above 10%, usually they will have to put it in the footnote and they will have to give you that data. So if they are in the other industry, you click here and you choose the other industry. I just make it up, broadcasting, okay? Let's say 90% are entertainment and broadcasting, they are 10%. Now I'm getting really a weighted average. See, broadcasting, it's 1.08, the beta, and the other hand in the entertainment, it's lower. So the weighted average.
Oh, so the revenue is like the percentage of the company kind of itascut.
Correct.
Like, you know.
Exactly. This is really part of their business, how many percentage of their business is in that specific industry. Yeah, absolutely.
Okay. And that will
and those numbers are usually, they might not give you percentage, but they might give you breakdown how much revenue from every segment. You can just plug the revenue here, it will calculate its proportion. So you don't have to worry about it. But if you have only one industry, you just delete this one, just put 100% here, and you're done. So it would be really just that one. Okay, but don't forget what we have now, it is the industry unleveraged beta. You need to convert it to leverage beta. Last time I showed you this equation, and if I ask question in the exam relating to this equation, I will put it on the question so you don't have to memorize it, okay? So what we do is how to convert from unleveraged to a leverage. We got the industry leverage, we multiply it by 1 plus 1 minus the tax rate in the US, 21%, and that we multiply by the ratio of how much the company has debt over how much the equity of the company. We plug it in this equation and we get the leverage beta. For Netflix, if you do that, you will get that you have to take the 0.87, which is right here. You multiply it by the beta, by the 87, you will get 165 because that company has a big debt over equity, okay? It's raising the beta to be higher. This is a leverage beta. This is unleveraged beta, and this is leverage beta. And this is the beta we need for the equation in this equation. This is exactly the beta we need in this equation. So now we have estimate of this beta, we have an estimate for the risk premium, we can multiply at the risk free, and we get our estimate of cost of capita. Let me change this one from United Kingdom to US. I'm going to cover that in a second. I just want to deal with a country that don't have any country risk. So what do we have here? We take the 1.65 multiplied by 525, and we add to that the 2%. By the way, there is an error here. I missed one line, and I'm going to fix it and upload it to, in a day or two, I will upload the new version. And this is really missing the 2%. If you take 1.65 times 525, you're getting this number. I need to add the 2%. I just noticed that. So I will fix it and I will give you here, it should say 1068. Okay? Fair enough. So if you really want to look at it in Excel kind of, I did kind of a little, how do you calculate that you have the 2%? If the country is risk-free, that means my leverage beta 1.65 times the 525, which is the risk premium, this times this, give me 866. This is what we got here, but the truth of the matter is I forgot to add the 2%. And if you add the 2%, the cost of equity for Netflix is 10.66. This is the way we calculate the cost of equity. One more thing that we want to add as we did for the debt. If you recall, when we said if the company is operating in a risky country, we should add some country default spread. The same things we do for the risk premium. After all, if I operate in Brazil, the risk is much higher, on investing in stock traded in Brazil. If the company is operating in Brazil, it will be riskier. So we have to account for that. So what we do, slightly different, but very similar to what we did in debt. First of all, we say, okay, what is the riskiness of that country? So we go, let's say if we change it to United Kingdom, okay, they are slightly riskier. I have to add spread of 0.4. That's what we did for the debt. How do we do the same things if we really want to do it for the equity? The way we do it for the equity, we not just only add 0.4, because this 0.4, the tables that I showed you, okay, and the country risk that a lot of those companies reporting, they're usually comparing how much is riskier to invest in bonds of the UK government versus the United States government. And the difference is 0.4 in this example. On the other hand, what we're really interested when we're estimating cost of equity, it's how much is riskier the stock market in the UK relative to the stock market in the United States. So it should be a really higher number. So we multiply the 0.4 by 1.5. What did I got that number for? Okay, I didn't make it up, by the way. This 1.5 reflecting how much is really the stock market is more risky than the bond market. Why do I do that? Because as I said before, the 0.4 reflect how much the bonds of UK government is more risky than US government bonds. But what I really should compare is how much is the stock market in the UK more risky than the stock market in the United States. Since we don't really have any index like that, what we really do, we just take the difference in the bond market and we try to adjust it. How do we adjust it? By seeing how much more risky is the equity market relative to the bond market. So how do you do that? You take the market portfolio, let's say the S&P 100, and you check the standard deviation. And then you take the government bonds 10 years government bond, and you calculate the standard deviation. You know, most likely it's going to be forever. The standard deviation on the S&P 100 will be higher than the standard deviation on government bonds. And that's really reflecting how more risky is the equity market relative to the bond market. Therefore, if we're only adding the spread based on the bond market, we multiply it by the ratio of the standard deviation on the stock market relative to the standard deviation of the bond market. In other words, the 1.5 that I gave you here, it's an estimate of several years of the ratio of the standard deviation of the stock market over standard deviation on government bonds return.
But both the bond market and the stock market are of the same country?
Yeah, this one we do the same country, although, you know, this is an excellent question. And everybody will ask, yeah, why don't you use the ratio on the stock market in the country you're talking about and the bond market in the country you talk about it? Some people said, why don't you just use the bond market and the stock market in the country that is the safest, okay? There's a big issue. Some people will say, okay, let's do what is the average between those two or just an average of the two. A lot of ways you will see it in real life, okay? Most common is to do it in the US because the data is much more reliable, okay? So it's really kind of a real life compromise, okay? But theoretically, I don't see why not to use the country in which you're doing business and take the debt ratio, okay? In any case, for you, Pepe, I would like you to have this discussion, and then you will say, based on the data you were given, you're using 1.5 to reflect that difference. Good. So now let's summarize. How do we calculate the cost of equity? Let's go back to that Excel, which really tried to explain this one. On one hand, we got the leverage beta 165. We have risk premium 525, but this time, since we're talking about riskier country, we're adding the country risk, and the country risk we multiply by 1.5. That gives me 0.6 that I need to add to the risk premium we calculated before. So we take the 5.25, we add it to the 0.6, we get 5.85. Now this becomes to be our risk premium adjusted for country risk. We take that amount and now we multiply it by the beta, we get the beta times the risk premium. Don't forget, we have, which I did forget, I needed to add, I probably just skipped that or mistakenly forgot to add the 2% to this one. So you take the 2%, you add it to the 9, you get 11.65. Okay, so that's really the way we calculate. Some people ask correctly, what happens if I'm operating in 2 different countries and each one of them has different risk premium, you know, different country risk? What should I do then? The truth of the matter is what you really should do in that case, take a weighted average of that country risk, and then instead of just using the 0.6, you would use the weighted average of those 2 countries, okay? But I didn't really add it to the simulation just not to complicate the analysis, but what I really should do, I might do, I just don't want to make it too complicated. The country risk should be a product of trying to do something similar as we did for the beta, to do something similar here for the country risk, and the weighted average would go, instead of the 0.4, it would go right here as a weighted average of several countries. It would be really hard for you also to get data on most of the companies, even the big one that traded in the stock exchange. So that's one of the reasons why I didn't add it to this simulation. Let me take a pause if anybody has a questions before I move on another method that we can use to calculate the beta. Any questions? Go ahead, guys. This is a good time to take.
Yeah. So in the formula for cost of equity, ACR, adjusted country risk, is actually the total country risk that we're seeing in the simulation?
Correct.
Okay.
Good. Excellent. More questions, guys? It's every step here is clear. It really is. If you look at the homework or the objective, by the way, it's maybe a good place to take a pause, a small pause. In a minute, I will continue. If you look at my assignments all along, they are built in such a way that eventually you will end up with a nice paper. Your assignment basically to summarize everything what we did in estimating the WACC. We talked about the debt, you have to summarize it. You can take a screenshot from the simulation and write explanation how it's being calculated. Write all the stuff that we should have used in real life, but we don't really use in the simulation. You do the same things for the equity, and then you take a weighted average of those two, which the simulation does automatically. By the way, just to complete, if you go here on the tab to the valuation, this number of 476, this is really the WACC based on the WACC equation. And it should be, this is really for the US. If I change this one to the US, it will be a little lower because then, let me redo it. I think I screwed up here. If I go into Netflix, maybe I was using another company, but let's see if it's for this country, United States. And if I choose 2019, and I will use entertainment, then I get the cost of debt, the cost of equity, and here I should really get, it should be 4.3. I probably was doing calculation here for a different company. We'll do in a minute some more example. But the cost of the WACC for Netflix is 4.3. It means we'll do other companies, part of which that you guys playing with, okay, or analyzing, okay. More questions before I move? This is really concluding the chapter of how to calculate the WACC based on the simulation. I would like to introduce one more way to calculate the beta, okay, instead of using the simple method based on industry beta, we can use a different method of more specific companies that relating to our company. If our company is, like Netflix is a good example, in fact, and Netflix might have, they have a big growth rate, they have a big debt of equity, and the industry of entertainment not necessarily reflecting what Netflix is. So some people will say, instead of using the industry average, how about if we instead take a specific companies and we implement it on those companies, okay? So this is the next method known as comparable companies. And I made really nice slide to really clarify the whole process. I might put a question like that, by the way. I won't put the steps, but I will require you, I will give you some data, and I will require you to be able to calculate that one. Of course, a question like that, I will always give you the equation. I don't really require you to remember it by heart. It won't be fair. Some equations like Gordon equation, I do require you to know by heart. It's very common equations. You use it all over the places for many purposes. So that equation I do require that you learn by heart. And we exercise it so many times. This one, I will give you the equation so you don't have to memorize it. But let's say I give you a question like that, and I said there is 3 comparable companies, okay? go ahead and do the calculation. How are you going to approach that? Stage number one, first of all, it's finding those three companies. It's already that easy task, by the way. Can anybody mention any company like Netflix in the US? Anybody? Honestly, nothing came to my mind immediately. What do you say, guys? Anybody have an idea? Anybody familiar with any company close to Netflix? How about if we go online and just write competitors? By the way, a good place to go is the annual report. In the annual report, they might write who they think they are the most competitor companies.
But their competitors are like Amazon Prime and Disney and
Exactly,
stuff like
could be,
that.
but they are not
The
that
problem,
magnitude.
they are not only in that. They are in other things.
Got
So
it.
they are not.
This is really what makes it so hard. So you will try to get maybe data on that segment, but you might find out that that's not such a big segment in that company, and therefore you won't get any data. So you might go competitor companies to Netflix, and I doubt you will get a list that it's really in. Who are Netflix main competitors? You know, you start reading and you say, and you start trying to find out, and you say, you know, you start reading and here they're mentioning one of them, okay? And then you look at them, you read them, and you say, well, are they really competitors? Many times, a company like Netflix will be really hard to find a competitor, to be honest. So you do your best. You do your best, and if it doesn't make any sense, you just throw it away. And for Netflix, probably I wouldn't kill myself because it will be really hard to find a good competitors. Amazon.
Actually, I think I know some companies in a lot of different countries. Usually, you have like a kind of a channel, a basic channel, and in that basic channel,
beautiful.
Let's say in France it is, I think, Canal Plus or something like that, and then that's when you have to pay a subscription, and then you have good movies that you can watch.
I was holding myself not to say stupid things, not to say Selco, but France is big enough to be a good example to, at least proportion-wise, you can learn from them to say, let's see what we learn from this company relative to Netflix. Selco I definitely wouldn't use just because it's not the same magnitude, it's totally different league.
Amos, what about something like Amazon? Amazon has a branch that's for like shows and movies, and there's also Hulu.
That could have been a good one. The only problem is, could you get data on that? Because it's most likely will be embedded inside the consolidated financial statements of Amazon. And if it's big enough, more than 10%, then Amazon would have to report it in the segment analysis. So in the segment, you might get the data. Okay, and then even then, they don't really have to provide everything you wish you had. So that could have been a good competitors, that sub-segment of Amazon. The only things become to be is practical. Do I have the data? Can I get the data? And that becomes to be real life, unfortunately. But you're absolutely right, that could have been a good one. Another thing, if I'm looking at Amazon, I would like to take Alibaba as a competitor. Is that right? But then somebody will say, hey, hold a second. Amazon, in fact, have another huge segment, which is Amazon Web Services, which Alibaba doesn't have. And then again, you get into the same issue, is Alibaba is a really good competitor. That's really becomes to be a real issue in finding good comparable companies.
I think in China they have something like Amazon. I don't remember the exact name, but they have something that is even better.
No, Alibaba is.
If I remember good, they have like everything is connected in China. It's crazy. A lot of time there is a lot of different things that let's say Facebook want to connect. That you can pay on Facebook and stuff like that, and there it was already done from like years ago. It's crazy.
Right. In fact, if you analyze the structure in China, same true about the Japanese market. They are very monopolistic markets in a sense. They control so many industries. You know, you hear about Toyota, you think Toyota is only cars. It's much more than that. Mitsubishi, it's a huge monster company, and they are all over the places in so many sub-segments. So it's really just telling you how real life is much more complex than the regular class that you take, okay? So, but let's assume that you really finally compromise and you say, you know what, it's true that those three companies are not exactly comparable to my company, but maybe if I look at their average, that will be better than just estimating my beta of my company. Because when I estimate the beta of any company, the variance of that beta is extremely high. The way you study in finance, you're running a regression of the return of the stock of that company on the market portfolio return. And usually this is very, very volatile. It has a very high standard deviation. And that's why we looked originally in the industry, and now we're trying to do the same things, a different method using comparable companies. In any case, I can't really be happy just because it's really hard to find comparable companies. I'm not gonna, you know, hunt you on the first part on actually go and find those comparable companies. That's why I told you in the paper, you can go ahead and utilize the industry average, which I already provided you. But I do like that in the paper, at least you mention all those points we talked about now. And if you get a questions like that in the exam, you do want to write a couple sentences about the difficulty in finding comparable companies. Okay, let's assume we got these comparable companies and we find three of them. We look for three major numbers. The third one is easy, is the tax rate, but three numbers. First of all, we look at how much debt they have, how much equity each company has, and then we calculate the ratio. So the first company, Columbia Sportswear, they have 20 debt. We have 2.239 equity, and therefore they have even less than 1% debt to equity. Okay. The second company has 138. They had 1,217. Therefore, they have about 11% debt to equity. The same for the other company, we get 67%. That's the first things we do. Then what we have to do is go and estimate the leverage beta for each one of them. In fact, we run a regression for each one of them, and we report here the coefficient of that regression. Another way to do, if there are traded companies, the most likely publish it on their website, or if you go even to Yahoo Finance, or more reliable, if you go to Moody or you go to one of those big companies, they might report it and then you don't have to calculate it yourself. In real life, when you have a real valuation that you do, most likely you will do it yourself just to be sure you haven't got a number by mistake or that company wrongly calculated the beta. Okay, so now that we have the leverage beta, remember this is for those companies and each one of them has totally different D over E. So our next step is taking this leverage beta of each one of those companies and convert it to an unleveraged beta. What does it mean, unleveraged beta? Unleveraged beta is as if the company didn't have any debt. That's really what it means. And some finance people have showed the relationship between leverage beta to unleveraged beta. And that is the equation. I will demonstrate the calculation in this Excel, will be easier for you. What I have done here, I just copied those numbers, D over here, I just put them here. I copied the leverage beta and I put it here. And then I wanted to show it's really missing like a column here, but it would be nice to add that column. I call it a coefficient. And what is that coefficient? What I'm referring to, it's really everything's in these parentheses. You're not taking 1 plus 1 minus t times d over e. I just calculated it for each one of those companies. So how did I get to this number? I just took 1 minus 1, plus 1 minus the tax rate. In this example, the tax rate is 38%. And that one I multiply by the ratio of debt to equity, which we already have in the first column. So I take this number, multiply everything in the parentheses, and I get the first coefficient. This one really shows me the relationship between leverage and unleveraged. So if I take the unleveraged multiplied by this one, I get this one. So if I have this one, which we have, I want to get the unleveraged, I have to take this one divided by the coefficient, I get this number. So this number is nothing but taking the leverage divided by the coefficient. And therefore I get 1.47. This one I do for every one of those companies. And I get 3 numbers. What is the common to all of them? All of them are unleveraged beta. It's as if I have 3 companies. Theoretically, I know what should be the beta if this company had no debt at all. And then I do an average of it. Some people will start argue, should I take a simple average? Should I do a weighted average? Weighted average means if I have a big company, I will take a more proportion in the calculation. And there's a lot of arguments, pro and con, for each method. Most of the time, people use a regular average because we don't really want to make like our company to be just like the biggest company. Because if I use weighted, the biggest company will get more weight, and that will be closer to their beta. So some people say we will use a regular average, and that's really what most of the people do in real life. Okay, we got the 0.9342 as unleveraged beta to be our estimate to our company unleveraged beta. But our company also has debt relative to equity. In this example, it's given the debt ratio, it's 26.68. So I plug that number right here. And I said, if I know this number, I can calculate for my own company that coefficient. Same things we did for the other companies. So what is it for my company? 1 plus 1 minus the tax rate times, this time, I will use the debt to equity ratio for my own company. That one would give me a number. And in this case, it's 1.17. And I know the link between those two numbers. This number times this number give me this number, or this number divided by this number give me this number. In this case, we already know this one. We assume that our company is relative to the other companies. It's very similar. So we said our company will have similar average of those comparable companies. So this is the unleveraged beta of my company. I will multiply it by this coefficient, whatever in the parentheses. I will get the leverage beta for my own company. By the way, this is the 1.09, just rounded up to 1.09. Okay, this is another method to calculate the leverage beta for my own company if I think that my company is very different than the average in the industry, and I can find companies closer in nature to my own company. I would go about and use more specific estimation of the beta. Remind you, I'm compromising on one hand and I'm gaining in other things. What do I mean? Theoretically, according to the CAPE model, I should have run a regression, and that's supposed to be my beta. But unfortunately, that beta has a big variance. So I said, okay, I want to get a better estimate that has lower variance. So that's why we take average of other companies. So we're gaining, by using comparable companies, we're gaining the variance will be lower. On the other hand, we are compromising that we never find exactly comparable companies. So maybe there I might compromising and my estimate is not as good. So this is real life, unfortunately. Either method will not be the right one. So that's why we do all those three. We run the regression, we have the beta for the company. We look at the industry average, we get a number. We do comparable companies, we get a number. And we're hoping that they will be close enough to each other. Therefore, the effect is not that substantial. And then we feel comfortable. For the paper, I really require you all only to report what I gave you already. It's this beta based on the industry, okay? And then explaining how I move from here to here. It's really using the equation that I mentioned before, okay? But do have the discussion of what we went over today. This is really, you should really learn this example by heart. It's excellent, excellent example. Let me take another pause and answer question if you have, guys. Go ahead. Any question, don't be shy. You know, it's better you ask the question and I answer it, then I'll put it on the exam and then you get stuck. So the more question you ask, the better it is.
I'm sorry, for the paper, did you say we should discuss the comparable company approach even though we don't use it?
Yeah, please put a paragraph. That would be nice, you know. It's really, you know, I always love to say to my student, I love the way they used to teach 300 years ago. You know, you don't really study for test. You don't study for getting a grade. You really study to know the material very well. I always mention the example of Maxwell. I don't know if you know the story of Maxwell. Maxwell, you know, he developed all the equations for electromagnetics. And he was a student of Beryl. Beryl developed all the equations of water dynamics. And then you say, well, how did Maxwell got to the electromagnetics studying in a library of somebody dealing with water dynamics? What is the link at all? And you'll be amazed how the equations of electromagnetics are almost a copy of the same equations in water dynamics. And at the time, when you get a diploma, it's not based on how many tests you passed. It's if you came up with a nice equations like Maxwell, or if you had some extra experiment in the lab of your professor, and that's the way you get a diploma. I really believe in that method. And unfortunately, you're getting so swamped with so many exams and so many assignments. So I wanted to cool down all the assignment I'm giving you and I'm directing you. Write it in your paper for yourself, you know, beyond getting a better grade. You know, when you're summarizing and you're writing a paragraph on this one in your paper, no questions, you're ready for the exam. If I put this question in the exam, you will do it in 2 minutes, you know, and you feel better. You really learn something. And honestly, this is really close to what people do in real life. So you're gaining many directions. Ready for the exam, you have a nicer paper, and you're ready for real life. And when you go to graduate school and you dive into deeper, this becomes to be trivial. Okay? Let me just, if we're talking about the questions, I'm adding, if you notice, as we go along, I'm adding questions to take a test. This is, by the way, my screen. So it looks a little different than the way you see it. This is the way I build, by the way. I can add answers, I can add questions. This is really an interface I built for myself. But basically, I'm adding questions here. And by the way, many questions here, I'm writing them so you can review the material. This is really like the slide we just covered. How do you use comparable companies to estimate the beta of our company? And here I just, you know, I wrote all the 3 steps separately, and the right answer is all the rest, yeah? Which is really just review. So utilize the take a test to prepare for the exam. And final note, if you really follow over the semester all my test questions, my assignment, I don't think you should spend more than a day to prepare for the exam. You'll be most likely ready. Okay? I hope this, I gave you a long answer just because I know the stress you guys in, and that's why I built the course in the way I did, to make your life a little easier and to enjoy the process. Okay, more questions on the WACC. Now that we have the WACC, we have cost of equity, we have cost, sorry, I didn't want to do that. I wanted to open this one. And to remind you, how do we calculate the WACC? We just calculated the RD. We just calculated the RE. Now we take RD times 1 minus T. Many people ask which tax rate I should use. Okay, in real life, what we use is the marginal tax rate. Okay, because we're going to use it in golden equation as well, and that goes for infinity. Okay, some people will say, well, let's split it. For the growth period, we will use effective tax rate. For the infinity, we will use the growth rate. But for your paper, you can use just, it won't make much difference. Take my word for it. You won't, even if you use 0, it won't make much difference. So we use the marginal tax rate. We take the ratio of debt to the total assets, meaning debt plus equity. That's the ratio of the debt relative to the total assets. We multiply it by 1 minus T, minus the RD, and then we add the RE, which is the cost of equity, times E over D over E. You will ask yourself, well, how do I find those numbers? Those ones are already given in the data section. And I already used them when I did, by the way, when you see here this number, this is already done, it's automatically for you. But the numbers are really here. You have all the data you need for those companies, for each company you use. So you have a long-term debt and you have equity. Yeah, so you do debt over debt plus equity, you get that ratio and you use it in this equation. You got the WACC. Wow, that's a big step. By the way, we have done a hell of a lot in this course. We already have the WACC. EBIT comes from the financial statements. This one comes automatically because it's the tax rate of the country we're operating, okay? Effective tax rate we have done before, that based on the calculation in the bottom here. We did it previous session. Then we had return on invested capital in the short terms. That's one also based on the calculation right in here. So the 7.26, if it comes to here, right from those calculations, okay? Then we looked at the growth rate, this one based on analyst, and we talked about it also last time. And this is really just 5 years estimate growth rate by analyst, okay? And that's pulled automatically for you. And now, let me ask you a question, just to review things we talked about them in the past. Anybody can volunteer. Don't be afraid if you get it wrong. I never give negative points. Maximum I give a positive point if I hear a nice answer. How do I get those 63.36? What does that mean? Reinvestment rate. What does that mean, reinvestment rate? Remember, we talked about it a lot in the previous sessions.
It's the money reinvested in the company.
Correct. So how do I calculate it?
Should be what left after the dividends taken out.
Correct. It's really
growth divided by the ROIC.
Excellent, excellent. Both of you were right. I take the 4.6, which is the growth rate, divide by ROIC, gives me the reinvestment rate. It is really the part G over ROIC. It's in the golden equation, and we've gone through it a lot. What does it really mean? This means that if this company, Netflix, wants to continue growing in the rate of 4.6, like the average in the industry, okay, this is, by the way, lower than what actually Netflix is going. If you see Netflix in real life growing much faster than that. But if they want to grow in the next 5 years in the rate of the industry, they should invest in the company 63% of their EBIT. So this EBIT should be really reduced, okay? Because that's I cannot really distribute as a dividend, okay? So, and that's really what it means by the reinvestment rate. So in the period of, you know, we have here all of that, how do I calculate the net capital expenditure? The net capital expenditure, it's really 63% of the EBIT of that year. This is the EBIT. I have here 4.6% growth, okay? I take the taxes out. This one becomes to be 63% of after tax of the EBIT. This one I have to reinvest in the company. Otherwise, I will not have a higher, this high 4.6 growth rate. That's something we have studied in previous session. Now it's the time to collect the stuff. Is that right? We're really collecting everything we have studied so far. Okay, and if you remember, we started with something really similar to that, but none of the numbers, I just gave you all the numbers. That's what you did in your finance classes. Let me open another screen. We open another screen and remind you how naive, and that's really the way you studied it in finance classes. And what we really did most of this course is really how do we implement it in real life, which is not really that simple. If you recall, when we started long ago, if I recall, we did it here. See this one, it's really very similar in structure to what I just showed you now. You know, you have the years, you have the cash flow, which is really this line. So I skipped all this part when I showed you this one. Here I just gave you the cash flow. It's growing 5%. In this example we're talking about now, it was really 4.6, yeah? Not exactly, but close enough, okay? So it's growing that amount every year. And then we have a terminal value. We spend a lot of time learning about terminal value. Here I skipped. And then I get the cash flow and I use a discount factor. This is really just the baby example to what eventually we're ending up with. We're just getting into more detail. We get the EBIT, we subtract taxes, we subtract net capital expenditure based on the growth rate. So we are linking that there is a relationship between the growth rate to how much I have to keep in the company. So if I have to keep more money, I have less cash flow to distribute as a dividend. Okay, so I can't just have a growth without reinvesting a lot. Okay, so they are really linked, and we finally see that, which in the baby example, we kind of ignored it. And that's really what you did in your finance class. Okay, now when we get into this class, we're really diving deeper. We're getting this number, by the way, this is the terminal value. We have spent a lot of time learning about Gordon equation. And in Gordon equation, we applied on the net. We take the EBIT, we subtract the taxes, we subtract the net capital expenditure. By the way, this number, don't get confused. We do not use the 63%, we use the 46%. Because in the steady state, and now I'm going to answer a question I gave you in the previous assignment. In the steady state, we don't assume the company is going to grow forever, 4.6 or whatever percentage we got. We're going to assume much more conservative numbers, and it's very important. If you think about a company that's growing more than the GDP of the country, That's illogical for if we assume this company and the economy going to last forever or for many years. What do I mean by that? Think about it, Israel. If Israel have, let's say now, several companies, and I have GDP, such and such, and one of the company is growing much faster than any other company, and I assume that this company is going to grow forever more than the average growth in the economy. What will happen 100 years from now? This company will be a huge company relative to the whole economy. Or another word, the whole economy will be this company, which doesn't make any sense. So to make assumptions about long-term growth, it has to be sensible because we're using the golden equation, and the best assumptions to use, it's really what we estimate to be the growth rate of the whole economy in the next long period. And 2% today, it's quite a reasonable number. By the way, I gave you some links, I think, in my presentations that you can see some forecast of the future. I think I put it, where did I put it? Let me see where did I put it? I think I might put it here. Let me see. Hopefully I will find it. I don't really remember exactly where I put it. Or this one we went through. This one we'll come back to in a minute. I don't remember where I put that link, but I will find it. I will mention it. If I didn't, I will put some link. But basically, there's many websites. You can even look them up, and you will find out that they're telling you what more or less it's the expected. By the way, the Federal Reserve publishes, the IMF publish forecast. There's many institutions publish those. The World Bank published the expected growth rate of the economy, and 2% is quite conventional today, and therefore why I recommend you use, and you can use it in your paper. The second part is ROIC, and if you have a good vision, you can see that I kind of plug the WACC at the same place. So I'm using the WACC to be my estimate to the ROIC. And why do I do that, by the way? The reason we do that, it's because, again, similar argument to what I did with the long-term growth in the steady state. If I have a company that their ROIC is higher than the WACC, that means that company going to take the whole economy. Is that right? You know, if I have a company making more profit than any other company, they're going to grow forever, and they're going to be the only company in the world. So that's why we limit the ROIC to be equal exactly to the WACC. For the same reason why we assume the company is not going to grow more than what we expect the whole economy to grow. So those two assumptions are very natural. You will see it in many evaluations of experts, just because any other assumptions will bring you to a situation that your company will vanish or will be the only company in the economy. And those are the two assumptions that you almost have to do, otherwise your valuation will suffer from a very basic problem of that in the long run your company will be the only one in the economy or will vanish relative to the economy.
Just an anecdote. Isn't Amazon growing like very much, and even in the long term they should, like, I think they are gonna take the whole world. It looks like right now. I mean,
you're
the
hitting
competition
exactly on this point.
You know, we have like someone that did a presentation about the Amazon and the anti-competitive way that they are doing, and actually they are killing the competition in a way that's crazy. And now they have even the contracts with the government for cloud. So now they are even, you cannot touch them. The government will not fine, will not give them fine and stuff like that. So
You're hitting on a very important topic, by the way, since, by the way, one of the next topic are special topics, and one of them I'm going to talk about merger and acquisitions, and remind me to dive into it a little more when we get into it. One of the things that I used to do, it's giving an expert witness in antitrust law cases. I usually didn't get into when you have a breach of the antitrust law. I usually worked on the part of valuation of the damage because of it. But it's very amazing field you're hitting on. That's really by itself worth to take MBA classes when you graduate and look for a good school for doing your MBA if you're interested in finance. And antitrust law mostly deal with in cases when one company is buying another company and that becomes to be monopoly. That's what I would say at least 90 to 95% of the cases. The antitrust law don't really touch areas that has to do, let's say you have I will make a really stupid example even, but a very good one. Let's say there are so many falafel, people selling falafel in Israel, okay? If I go and buy all of them, that will be a breach of antitrust because I'm become to be a monopoly and I might affect the prices of falafel, okay? On the other hand, if I start opening my own store next to each one of the stores of falafel and I start selling it in reasonable price, by the way, people will invoke antitrust if you sell it below your cost. But let's say somebody else next to me is selling falafel for 15 shekels. I'm selling it for 10 shekels. I am barely making money, but my first step is to get him out of the business. It would be very hard to complain about my behavior to the antitrust office. They will not intervene because they said that's the competition. He says that for $10, that's a competition. But the truth of the matter, I have a long plan. If I have a big pocket, I'm really getting all those guys going to be bankrupt. And then eventually I will be a monopoly, just in a different way that the antitrust law won't catch me. And that's really what's happening in Amazon now. In some respect, if you look at, since they got really heavy into the, all these warehouses all over the place, delivery was in the same day or the following day, fast response with all this infrastructure. By the way, they don't really make money on that stuff. If you look at their financial statements, and I'm very surprised that they don't tackle the fact that they don't really make any money almost on that part, which means they're really kind of on the border of breaching antitrust law because you're not supposed to give a service when you're not making money. So that's a really hard, but it's really hard to show it in court so they can get away with it because they're not really getting the advantage by buying places, okay? So you're hitting on a very big topic, which I would love to talk. This is one of my expertise, and I love the valuation because I do valuation not only on valuing company, many times I do valuation of damages, what the damage caused by antitrust law, which is a very beautiful topic and a field you might be interested one day. I gave you a long answer to usually a short one, but it's really a very important question you raised. Good one. More questions, guys? Anybody? More questions? By the way, here I will ask you a question. We calculate the reinvestment rate, we got 46.51. Is that right? This is the long run. So when I calculate that amount, I will take this one minus this one, multiply it by 1 minus that one, that's what left as a cash flow. If I ask you in the exam, could this number, let's start with an easier one, can this one be higher than 100%? And what does it mean? Anybody?
It means that you're investing all your profits plus borrowing money.
Exactly. You're even raising more money, which many companies do. Let's take an example. If I assume that this company, that's a Netflix, in real life, they're really growing more than 4.6. Let's say they're growing 10%. What do I get? 137. What does it really mean? That means that the cash flow in the next 5 years is going to be negative, which makes a lot of sense because they're raising more money to grow. Otherwise, they wouldn't go at the 10%. That's pretty cool. Something we couldn't think about it. It's like if they go 7.26, that means all the money is gone. I'm not distributing any cash. Well, but let's go back. Let's go back to the 4.6 for a second. 4.6. Okay? And now it looks like a puzzle. The valuation is 78. If I increase the growth, I just make it 7.26. I'm not distributing anything. The whole amount goes for reinvestment. That means no cash. What do you think? That's raise the value of the company or that's increasing the value of the company? Anybody? Now we're dealing with the real numbers, by the way, which is really cool. What do you think? The value of Netflix should go up by raising the growth rate, don't distribute any dividend. That's really what it means. No distribution of dividend. What do you think?
It doesn't affect if you are distributing dividend or not, it's not really affecting the value. Because actually, if you have a share of it, then if you keep the dividend, the value of it will go up, right?
Oh, you're saying, I agree with 2 points. You said 2 points. One, I'm not distributing dividend now. That doesn't mean I'm not going to distribute in the future. And that should increase the value of the company. Absolutely agree. Because first of all, let's look at the number. Yeah, the value went up. Did you notice? Okay,
yes.
Let's go back to 4.6. So you can see it, 4.6. The value of the share was only 78. It went up by not distributing. In fact, I really didn't, not distributing anyway a lot, but even not distributing at all, the value went up. How is that happen? How can you explain this increase by almost $5 a share?
Because
Why not distributing any dividend? And I will help you out a little bit. I'm not distributing only in the short term, in the 5 years. What's going to happen in the future? So where is this increase in the value of the share came from? What about
because you have invested the money to make the company grow, meaning the future revenues will be higher and stuff like that.
Yeah, but why? But I'm not having any value here. You see 0, 0, 0, 0. So that number must went up. Otherwise, it doesn't make sense. Let's see the logic. Let's go back to the 4.6. Okay, let's go back to the 4.6. Okay, notice how much was the terminal value? 611. You see that number? Okay.
Yes.
What happened when you don't distribute any dividend? Okay. What happened now? It becomes to be much higher, which means whatever I'm not distributing now, people are going to get in the future, and that comes into golden equation, that the company value goes up and the cash flow in the future will be higher. That's the meaning. And in fact, for a company like Netflix, I would tell them, you know what, not only don't distribute dividend, why don't you go and continue? And that's what they're really doing. They have a huge growth rate, and if you see the growth rate, it's really high. I think it's even more than 15%. That means they're even raising more money today in order to make the company much more bigger in the future. And in the future, they're going to distribute, see, this is not 100%. That means that 54% almost going to be distributed in the future, in the long run, as dividend. And that brings more value per share. So that's why we're going to 95. So they really should borrow, they should really continue, as long as their return on invested capital, it's high, they should really grow. You know, the ROIC, it's higher than the WACC. So the ROIC is higher than the WACC, I should have really increased the growth rate. That's increased the value of a company like we have seen before. So if I see here more than 100%, don't get confused in the exam if I give you a question like that. All what it says is that the company reinvesting all their profit, and more than that, they're even raising money to grow. And the reason they're raising money to grow is because the ROIC is higher than the WACC, and we know as long as the ROIC is higher than the WACC, like Netflix example, no surprise that Netflix spending a lot on growth. That's really what they should do, because that one increase value. Truth of the matter, the market even pricing it's better than even it should be. You see, we went up from 78, we jumped almost 30 points, okay? But still the market even valuing it's much more. But that's a different discussion for a different course, okay? But at least I would say, based on the numbers of Netflix, no question that Netflix should go, even not distribute any dividend, make a lot of sense, and raise the growth as much as possible. Surely enough, in the long run, we never really hold the whole dividend because the value of the company will be zero, really. Doesn't make any sense. Is that right? You know, I can't really get to a point, you know, it will be, you can't really do it. You can't really have the WACC, but if you had here a value, you can't really, the golden equation collapse, but you can't have a company that in the long run, it will be here 100%. Because 100% means I never distribute dividend. That company doesn't worth anything. It's like I have a monster that grows forever, but I never get a penny out of him. If I don't get any penny out of him, it doesn't worth anything. So that's why the equations really breaks. It works only on the cases in which the growth rate is lower than the WACC, okay? And we assume that the WACC and the ROIC in the long run must be the same, otherwise we get illogical issues. And by the way, if in the long run my rate is higher, that also will increase my value. Also, I'm keeping more. See, I'm keeping more in the long run also for growth, okay? The only way I can have 3% is by keeping more, but eventually I'm distributing more from a bigger part that's supposed to also increasing the value. As we see, it went up to 97. So growth in the short run or the long run will increase the value of the company. But I never can get to a point that I will have reinvestment rate more than 100% or 100% forever for the short run and in the long run. That doesn't make any sense because it means that I never distribute any dividend. That means this company, I get nothing out of it. This value should be zero because I'm never getting, it's like somebody that goes to work and never eat. You know, it will die eventually. You know, his bank account will be huge, but eventually it will die. So you can't really save all your money forever because otherwise you don't worth anything because you don't eat anything. That's really equivalent to that. Okay? I think this is summarizing or a good preparation for next week when we start diving and we talk also about some adjustment. I will finish this one and then we start talking about what minority interest means and how should we account for it, okay? If we do have, and when does it raise? That has to do with the future topics. If we go along here, we will see next topics, I call them special topics. The next one we're going to talk about is merger and acquisitions. In my opinion, it's the most important topic for you. Unfortunately, it's too advanced topic for your classes in accounting, but I think at this point you are in a level you can handle it. I built a special Excel for that. I didn't really have time to make it as a simulation as I did in other. By the way, if you want to start preparing, this is I recorded from previous year. So you can see even the video. It's, in my opinion, the nicest class or session, the shortest to explain one of the hardest topic in accounting or corporate valuation. And I would make it as, it really should be easy. Many times I like to put a question just the way it looks like, just erase some numbers and make you fill them up. And that's what we'll do next week.